As we told you earlier in the program, the Reserve Bank has added its voice to the warnings that investment markets are failing to price in the risk of a rise in interest rates. Now, for the view from the market, we're joined on the program again by Roger Montgomery from Montgomery Investment Management. Welcome to the program, Roger.
Thanks, Andrew. Delighted to be here.
Both the Reserve Bank and the Bank for International Settlements are warning that markets have stopped pricing in risk. As an investor, I guess you're one of the people they're talking about.
Well, it's interesting. We actually, in our funds, have in one of the funds, about 37% cash, simply because we think the risk level is too high. There aren't many high-quality businesses that are currently cheap. But I still believe in order to have a bust, you need to have a bubble. Something needs to bust, and we don't have a bubble yet. We don't have bubble-like conditions in many markets. There was earlier in the year in technology stocks in the United States, we saw companies like Amazon trading at 1,400 times earnings, but that's come off a considerable way now. And so I think we need bubble conditions. We haven't got that yet, and I think we've got a mandate that's been indicated by the Federal Reserve in New York, that they're Federal Reserve in the United States, that they're happy to see higher stock prices, higher asset prices, and they're not worried about bubbles.
We've just heard Professor Bob Gregory disagree with the Bank of International Settlements' assertion that we're seeing conditions which could see another global financial crisis worse than the one we're still recovering for. What's your take on that?
Well, I don't think that we've seen enough money move out of the safety of cash and into risky assets to produce those bubble conditions. So
you don't think investment markets have been distorted by cheap money?
Oh, absolutely they have. There's no doubt about that. PE ratios for stocks are higher today than they otherwise would be, but it doesn't necessarily infer that we're going to have an immediate crisis or an immediate crash. I do believe, though, that we will have one. It's just that we need to see a real bubble develop first. Now, Christine Romer, who was Obama's head of the Economics Advisory Committee in the United States, she came out last year and gave a conference or a lecture at Johns Hopkins, and she actually inferred that the Federal Reserve was being unnecessarily guilty about the previous bubble and worrying too much about future bubbles and not worrying enough about economic growth. And the Federal Reserve has a dual mandate to maximise employment and also keep an eye on inflation.
But when you look at things like the level of the US stock market at the moment, it's hard to see earnings catching up to where shares are.
I think that's true, but we also know that the Federal Reserve is trying to instill confidence in people to spend. And Christine Romer talked about Franklin Roosevelt and him coming 3 months after inauguration, getting rid of the gold standard and using the Treasury to buy, using the revalued gold and inflow of gold to buy government bonds and increase money supply. The inference is that the Federal Reserve wants to do the same thing again by pushing asset prices up. The idea is that creates a wealth effect. So if people see their house prices go up, they see stock prices go up, they gain confidence, they start buying trucks, they start buying tractors, and that's what we need.
But as an investor, how do you negotiate your way around all this and find genuine value when asset prices and markets are distorted?
You have to be really patient. You simply have to wait for those rare opportunities where good companies fall on temporary hard times that the market treats as if it was permanent, and buy those things when they come up. So at the moment, we cannot find enough opportunities to invest all of our cash. So we've still got a substantial amount of money sitting on the sidelines, but we believe that a negative real return is better than a significantly larger nominal negative return. And so it's better to sit in cash, the safety of cash, than to buy things that are either expensive or poor quality. So all you can do right now is wait for great quality businesses to fall on temporary hard times. There might be downgrades in the upcoming reporting season or a downturn in their outlook, and as a result, you'll pick up great quality companies cheap.
Don't follow the crowd.
No, absolutely not.
Roger Montgomery, thank you very much for your time.
Pleasure.